Hello, and welcome to episode 80 of the Reconomy podcast, where we discuss economic issues that impact real estate, housing, and affordability. I am Odetta Kushi, Deputy Chief Economist at First American, and today will be part three, the final episode of our three-part series where we answer audience questions. And of course, that means that the whole team is joining us again today. We've got Mark Fleming, our Chief Economist, here with us. We've also got Xander Snyder, Senior Commercial Economist, and of course, economist Ksenia Potapov. Well, thank you all for joining us again. I'm really excited for today's episode. And today, instead of picking on Mark first, I'm going to go to Ksenia. And Ksenia, you'll be answering our first question. And our first question is actually about migration patterns. What markets are experiencing strong net in migration, and what markets are experiencing out migration?
Right. So I think in a surprise to no one, the cities that experienced the most in migration were in the Sun Belt, at least according to data from 2022. These were cities like Austin, Dallas, Houston, a lot of Texas, Nashville, Raleigh, Jacksonville, a lot of these cities. And the cities that shrank the most were often larger, more expensive coastal cities like New York and Los Angeles are on the list, but not exclusively. There was also New Orleans, Cleveland, Buffalo, so some of these smaller cities. But when we're talking about some of these city migration flows, we're actually looking at a very large geographic area. So for all of those who read our blog posts, we often mention that this is a metropolitan area that we're looking at. So for example, when we're talking about New York, that is actually the New York, Newark, Jersey City metropolitan area, which spans 3 whole states. So it helps to break it down a little bit further into the kinds of areas within those metropolitan areas. So again, in 2022, urban areas in large cities saw the most population decline, which is, I believe, a surprise to no one. Again, this is a trend that we've seen since before the pandemic, decline in urban cores, but it was accelerated during the pandemic. And so it stands apart from the rest of the kind of mid-sized small cities and suburban areas, which all gained population. So this is a trend that's been going on again since before the pandemic. And it also suggests that, again, the millennials who really like to live downtown, and it seemed like they would never follow their generational predecessors and move to the suburbs, are actually doing that now.
That's right. We are seeing that quite a bit. It's also interesting that you're seeing these migration flows. I'm assuming a lot of young people moving out of traditionally more expensive areas like New York and LA to Sunbelt markets where you're seeing not only good weather, but strong job growth and amenity growth as well, right? So you're seeing in a lot of the Texas markets are booming, and so I find that very interesting.
Yes. And in some cases, you've also got work from home, which allows you to work from somewhere else.
Yeah, that's absolutely true. We've seen a lot of people move out to less expensive markets because they can at this point. All right. Well, the next question is a little wonkier, which means it's going to Mark.
Ay, ay, ay.
So I took this question exactly as is here, and the writer wrote, one thing I never hear anyone talk about anymore is trade balances and imbalances. Do exports matter? Do imports matter? How does the strong dollar impact inflation for the average consumer? So Mark, put on your macro hat.
That's like 3 or 4 questions in one, and it actually gets to a little bit of an issue or a way in which we measure the numbers. When we talk about GDP, and particularly over the last couple of years have focused on where the GDP growth has gone negative, and if it goes negative for a couple of quarters, are we in a recession, which we've talked about is not the definition of recession. But one of the accounting measures is net exports, or exports minus imports. But you have to be careful because actually imports don't matter at all. Imports were not made in this economy. They were made in some other economy. And so technically speaking, they do not count towards our GDP. The reason they are a negative minus imports in our economic accounting is our consumption numbers. The consumption dollars include the consumption of those foreign cars that we've bought. And therefore, it's a mere accounting necessity to extract the imports because they're in the consumption measure. So the answer to the question is no, the trade balance doesn't really matter. It's the export number that matters because obviously that is made here and does count as part of our economic activity. And to answer the last part of the question, it matters relative to the price of the dollar, because when we export that good and the dollar is expensive relative to other currencies, it makes our goods more expensive relative to their own domestic goods, or vice versa. So exports is not just about us making it, it's about how well we can sell it given the strength of the dollar. So those two things are actually tied in that sense.
That's a really good and nuanced point for people who don't necessarily follow the national income accounting methodology, and like we
And
just follow
hopefully
that.
they never have to. But it also means that we export inflation, right? Which is something we have done historically over the last couple of decades. We've been able to export inflationary pressures, so by strengthening the dollar in the last couple of years, I should say.
That's a good point. That speaks to the second part of their question on inflation. Okay, thank you for that, Mark. I think, is the next one for me?
Yes, it
Let's
is.
see. It is. Rate lock-in effect. Just how rate locked in are consumers, and what could alleviate that effect? Nothing?
That's not true. There's one very specific thing that could alleviate it.
Oh, okay, good.
Rates going back down to 3 to 2%. But that's just
odds
not
of
going to
that
happen.
happening?
Very,
Yeah.
very low. Very, very low. So consumers, existing homeowners rather, are very rate locked in. So about 90% of existing homeowners are locked into rates below 6%. And it's about 80% of existing homeowners that are locked into rates below 5%. Rates in today's environment are, near 7%. And so a lot of these existing homeowners do not have a financial incentive to sell their home. And so they're very rate locked in. In regards to what could alleviate this, there's a couple of things that we like to look at. One is that 42% of owned homes are owned free and clear. So these individuals are not rate locked into their homes. They don't have a mortgage at all. And so they're free to move. Of course, they would be locking in a 7 to whatever the mortgage rate is, 7 to 8% mortgage rate. But that is one potential way that the market could overcome this rate lock-in effect, is through those homeowners that own their home free and clear. The other factor is that existing homeowners are sitting on a ton of equity at the moment. And so even though there's higher mortgage rates, they could potentially use that equity to bring a higher down payment to their next home, which could, again, mitigate some of the impact from the rate lock-in effect. And of course, if you move to a less expensive market, Ksenia was just mentioning migration patterns. If you move from my market, for example, Washington, D.C. to, let's say, Buffalo, New York, I could take that equity with me, and maybe that could help to mitigate the higher mortgage rate environment as well. So it's not hopeless, and general consensus expectations are that rates will come down next year. It just likely won't be enough to unlock all of these existing homeowners. All right.
Buffalo.
Go Bills. All right, Xander, this next one's for you, and it's all about maturing debt, specifically maturing office debt. How much risk does it pose to the industry and the overall economy?
Right. Well, in 2023 alone, by the end of the year, about $190 billion worth of office debt will have matured. And that includes everything: bank held, non-bank held, commercial mortgage-backed securities, or CMBS. And in 24 and 25, an additional $210 billion or so in office debt is expected to mature. So I think the consideration is, how is this going to impact the lenders? And the first thing to keep in mind is that about half, actually a little bit more than half, of all outstanding office debt is held by non-bank lenders. So life insurance companies, investor lenders, mortgage REITs, for example. Now, the reason that it's important to keep that in mind is because, as it relates to the risk to the broader economy, the systemic risk from a lot of mortgage maturities occurring, and then those office owners having to refinance at higher rates and maybe not being able to get that loan, is what happens to the lender. And fortunately, there's only about a third of all outstanding office debt is held by small banks, and the larger banks have actually already pulled back commercial real estate lending meaningfully over the last couple of years. So the takeaway from all of those numbers is that there are risks to banks and non-bank lenders when these mortgages come due, but they will probably typically be at smaller banks, and they probably won't represent contagion risk of the sort that we saw in the great financial crisis, because you don't have the trillions of dollars of notional derivatives on top of the mortgage. On top of the mortgages that exist, there are new capital requirements in place that didn't exist then. So I don't think that we're free and clear yet. We're not through the worst of it. I think there will be real risks, but I don't see it becoming systemic and widespread to the extent that we saw in 2008, 2009.
All right, some sort of good news and a lot of bad news, and you managed to sneak in derivatives into the conversation. So I'll.
You're welcome.
Yeah,
Notional.
exactly.
I think the word
Notional
notional.
derivative.
Well, I got to go look that up.
I know. Thank you, Xander. Mark, this one goes back to you, and the question simply asks, recession risk, question mark? I assume that's asking you if you think that recession risk is higher or lower.
So I think
Take it away.
I think we need to talk about wisdom of the crowds and cows in this particular
Yes.
answer. There is this belief that you can gain more by asking from the wisdom of predictions from the crowd than from experts. And a study was famously done where you ask at the Iowa State Fair a bunch of random people how much the cow weighed, and they gave a variety of answers from 1 pound to hundreds of thousands of pounds, because who knows how much a cow weighs? I don't really know. And then they asked a bunch of the farmers who should know how much cows weigh. And it turned out that the average answer from those who had no expertise was actually more accurate than that of the so-called experts. So now we will turn to the so-called experts on recession risk, aka all of us economists. And the odds are suggesting that when you survey them, they say, yes, it's less likely, but there's a lesser chance of a recession in the next 12 months now, 12 months from now, as there was, say, 6 or 9 months ago. But I must caution that we have been notoriously bad at predicting recession risk. My own personal opinion is I don't think that there will be a recession in the next 12 months. We have to put some sort of a number on it because it's not as if we've broken the business cycle. There will be a recession at some point, but not due to the monetary tightening policy that we've seen on the part of the Fed, in large part because the Fed is likely done at this point with most of, if not all of its monetary policy tightening, and the economy has held up extremely well to it.
So a soft landing next year is what you're predicting.
I suppose if you have to put the label on it, they are saying it's a soft landing, yes.
All right. Well, that's a good one. We'll take that. And this next question, I actually would love to take this next one. It's an interesting one. It is, how do you explain new home building as the bright spot? At the same time, there is lower builder sentiment. There seems to be a disparity there. That's a really interesting question because we saw in the latter half of 2023, we saw home builder sentiment stay quite low and decline, whereas single family permits and starts were indicating cautious optimism. So what's going on? Well, one thing that might be going on is that the survey for the builder sentiment is a survey of smaller builders. So the median number of housing starts for builders was 6. And so this survey of smaller builders, but it's really the big builders that are outperforming in today's market due to their ability to offer incentives. And so, you're seeing housing starts and permits do quite well. You're seeing builder sentiment very, very low. Part of that discrepancy could be due to the methodology behind the survey, which is serving smaller builders compared to the larger builders, which, as I mentioned, are faring better in today's market.
Sample design.
Sample design, exactly. But, it's important to note that traditionally that builder sentiment does track quite well with housing starts and permits. But this market of 2023 has been anything but normal. Okay, Ksenia, this is a great question as well. There's a lot of talk of how it makes more financial sense to rent versus to own in today's market. Do you agree? What is the value of homeownership?
What is the value of homeownership? It's such a big, important question.
It is.
So we can tackle this.
We asked the
Yeah.
renter on the panel.
We did.
The one.
The one renter on the panel.
Yes.
Well, so as we all know, part of the decision to become a homeowner is financial. So there's a couple of ways to look at the be a renter, be a homeowner, which one is better question. So one angle from which you can look at it is, this is a financial decision, and it's mostly based on your monthly payment. Can you afford to pay a mortgage and everything associated with owning a house month to month, and what is it in relation to what you might pay for rent? And so in our rent versus own analysis, we do just that. We compare the monthly cost of renting and the cost of owning. Now, mind you, this is not the cost of buying a home or any of the closing costs associated with it. This is just the cost of living in that home month to month. So the mortgage payment, taxes, homeowners insurance, repair costs, etc. And so according to this analysis, in the third quarter of 2023, it was better to own nationally. So it meant that it was actually cheaper month to month to own a home than to be a renter. Of course, this depends widely city to city because real estate is local. So what we saw in the third quarter was actually that cities where it was better to own were those where house price appreciation was relatively high and high enough to offset the cost of a 7% mortgage rate. And also, generally, these were cities where house prices were already relatively low. So we're talking about cities like Buffalo again, Cleveland, St. Louis. Yes,
Go
Odetta. Yes, and on the flip side, it was cheaper to rent in cities that were typically more expensive and also had low or negative house price appreciation. So these are places like Phoenix, Austin, Denver, Seattle. And now an important part of that calculation is actually the house price appreciation bit, because this is something that the renter does not have. If you own a home, you also benefit from equity gain. As your home appreciates, you also, an asset that you own appreciates. And this is a large reason why homeownership is touted as one of the most effective ways of building wealth, especially for low-income households. We see this in some of the wealth data in the Survey of Consumer Finances that recently came out in October with a 2022 update, that homeowners on the whole have 38 times the wealth of a renter, and homeowners are also wealthier than renters at every income category. So if you take a homeowner household and a renter household who earn the same income, the homeowner household will be wealthier because they own an asset that is steadily appreciating. So it's not surprising. So all in all, the evidence points to homeownership as being an incredibly beneficial financial decision. I say that as the only renter here.
One day, Ksenia, one day.
When we miraculously find all of that new supply as people become
Yes.
unrate locked in.
Yes.
I'm
Thankfully, I can
Technical
wait
term,
10 years.
right? Or wait 10 years. Yes, exactly.
That sounds
Yeah,
a
this
little
is-
like uninversion.
Reversion.
Yeah.
Reversion.
And this is your episode of First American Grammar. Okay. Sander, the last question goes to you. What do you see as the time frame for price discovery in commercial real estate, and will it vary meaningfully by asset class?
Great question. I think this is tied closely to the question that I just answered a little while ago about mortgage maturities. And the basic reason is this. Right now, there's a big disconnect in terms of what buyers think properties are worth and what sellers think properties are worth. And that's basically why transaction volume is very low right now. If you are a prospective seller, if you are an owner that doesn't have, great refinancing options right now, and your mortgage isn't maturing for a year or two, you might just wait and see. Wait, what happens. Maybe rates will come back down in the future. Who knows? It is when those sellers or prospective sellers, the owners, no longer have that wait and see option, when they are forced to come to market and they become what I like to call a motivated seller. They have some motivation to actually sell. So a lot of the deals that are happening right now, there might be seller motivations. For example, a high net worth individual might just be not interested in owning a building, or a fund might be closing. So these are the sorts of deals that are occurring right now. Now, as these mortgage maturities happen and essentially remove that option to wait and see from a lot of the existing owners, that's when we're going to begin to see transaction volume pick back up. And if you look at the pace of maturities over the next year or two, as I mentioned, there's a lot coming in 2024 and 2025. There's even more in multifamily than in office. I think it's about $500 billion in multifamily mortgages come due in 24 and 25, but multifamily is a much bigger market than office, so that's part of it. But as those come due, a lot of owners are going to say, okay, well, what are my refinancing options? Do I have refinancing options? And if they don't, then, they might hand keys back to the lender. They may try to restructure, but it's that pace of mortgage maturities plus whatever the lag time that follows to work out the loan or for the bank to sell the property as the collateralized property. You figure we will probably see transaction volume begin to pick up towards the end of 24 and into 25, factoring in that maybe 6 to 12 month lag period after when the mortgage maturities occur. So it's closely related to when a lot of the debt comes due, unless rates come back down, in which case I imagine that would be the primary driver of volume picking back up.
And I think you suggested that faster in multifamily than, say, office, because there's more loans coming due in that asset class.
Yeah, and additionally, I think the quality of distress that we'll see in multifamily is quite different than in office, because if we're heading towards a recession and multifamily prices correct meaningfully, then, there's still demand to have an apartment and live. We need places to live.
We need places to live, but we've already established we may not need those places to work in those offices.
And therein lies the problem.
Exactly.
The supply demand, it comes all back to supply and demand dynamics for office have really meaningfully changed. Not as much for multifamily. That doesn't mean people won't lose money, but it means that people might be able to get in at a good cost basis for apartment properties at the beginning of a new cycle. That sounds more like an end of a business cycle problem than what office is facing.
That's a good point. It's, if commercial real estate is not a monolith, and so it's always important to look at these dynamics by asset class. Thank you, Sander. All right. Well, that's all the time we have for Q&A today. I know. I hope we were able to shed some light on a number of different topics ranging from residential and commercial real estate. Thank you all, Mark, Sander, Ksenia, for being on this series all together. We'll have to do this more often. I had a lot of fun. I don't know about you guys. And to the audience, thank you for joining us on this episode of the Reconomy podcast. You can check out our blog posts on firsthand.com/economics. And as always, if you can't wait for the next episode, you can follow us on X. It's at Odeta Kushi for me, at mflemingecon for Mark, at Xander Snyder X for Xander, and at Ksenia Potapov for Ksenia. Until next time.